But basically what that means is this is a multi-bagger to the max. 15% return a year for 20 years essentially is 16 times your money. I have a growing list, currently stands around 20 or 25 stocks that I would like to own for the long haul. This came with very minor screening, but most of these are based on good balance sheet and great businesses, right?
Yep.
I don't know which companies on that list that you know of did you not like that I had. Either way, we're going to do 3 of those companies today. But Mo and I, we're going to go through this process. We're going to use a stock analyzer tool. We're going to discuss each company. We're going to be more thorough on the first one to show our process. So if you're new to the channel and it feels overwhelming, don't worry. You just got to watch more videos because it's overwhelming for everyone when they start. But if it clicks and it makes, you don't need to understand it fully. It just needs to make sense to you. If it makes sense to you, keep listening. We look at all investments as the present value of all future cash flow. The question is, what will that future cash flow be? And our thesis is we want to be more conservative on it. That way we buy at conservative prices because our capital is limited.
Yeah, exactly. Only one stock I disagreed with you with so far. Not even disagreed. It was just the sector worried me, and it was Southwest. Just the airline sector.
Yeah. Well, listen, the sector sucks.
But when we looked at the company, I was like, interesting.
I think Southwest is the anomaly of the airline industry. Yeah, just like I think Tesla is the anomaly for the auto industry once it gets to a fair price.
Exactly.
So, first stock. It's a little known company. It's not very popular. It's called Google. Now, Google owns the top 2 search engines in the world. What are they?
Google,
YouTube, and YouTube. The very channel you're on right now. That's the second largest search engine in the world. So let's take a look at it on our software. So Mo's already pulled it up.
Yes.
$96 a share. Its all-time high was $152.10 earlier this year. It had a split recently of, what was it, 20 to 1? So that's equivalent of being 1900 and whatever right now. 1920?
Yep.
Okay.
Great ROIC. I'm surprised they don't pay a dividend, to be honest with you.
Why is that?
Thought they would.
But look at this. I think they probably have a lot of growth potential here. I mean, with a high ROIC.
So the only other massive market cap company that doesn't pay a dividend is Amazon, I think.
Yeah, but Amazon can't afford it.
I know they can't afford it. But these
I shouldn't
guys
say they can't afford it, but so here, gross profit margin 56%. I'm actually surprised. I thought it'd be higher than that.
The gross profit.
Yeah,
actually, I agree.
But pretty consistent profit margin.
Yeah,
1 year is 23.7, 5 years 23%. And the difference between gross margin and profit margin is your taxes, selling, SG&A expenses, overhead, etc. All right. Market cap of 1.25, enterprise value of 1.34. The difference is the debt.
Yep.
Now, I don't think this takes into consideration of cash, but either way, so far so good. Let's go check out the 8 pillars.
Yeah, that's the pillars that we like seeing.
And guys, something new to our software, we allow people to make their own 8 pillars. Don't live or die by our pillars. If something you don't care about something, you can change it up. We'll still keep our pillars here so you compare, but some people don't even care about certain things.
I have mine pulled up here.
Oh, you do your own?
I changed it around.
I don't.
I did PE of 20. I actually made ROIC a little higher.
Oh,
over 12.5.
Somebody's messaging you.
Just got a message.
Somebody's messaging you.
A dividend. I want to be paid a little dividend. Market cap over 10 billion. So I was kind of narrowing it down, playing with different things yesterday because this is a new tool.
And guess what? I like the 8 pillars the way it is because it was my 8 pillars. So it's kind of like, I don't need to make my own. But here, 5-year PE, 5-year price of free cash flow, very high, 28, but they have a high ROIC. This high ROIC means that they don't have to invest as much money in the business to get more growth. Yeah. So at some point, they're having more excess cash flow they can use to pay dividends that Mo wants them to pay, buy back shares when they're cheap enough, pay down debt, things like that. So that's the benefit of a high return on invested capital. Let's go to our analyst estimates.
Yeah, they started buying back shares in 2019.
F them.
Yeah.
All right. EPS, 486. Analysts estimate, a lot of analysts estimate 811 in the end of 4 years from now. Revenue growth. What is that growth, by the way? That's mid-teens. This revenue growth, not much. 290 to 376 over 4 years. What is that? High single digits? Yeah. Okay. Great. So the stock analyzer tool, what we started to do lately is, Mo, do you want to do a 20-year or you want me to do a 20-year?
You do 20-year this round.
Okay, so Mo's going to do a 10-year analysis, which you can select here. I'm going to do a 20-year analysis. And the big thing, this is the most popular part of our software because it allows us to make assumptions about the future because we don't know the future, but we do know, and this is something I want you to understand if you're new to the channel. Every investment is the present value of all future cash flows. The hard part about investing is we don't know what those future cash flows will be. Are they going to grow? Are they going to decline? Are they going to stay the same? Are they going to do better than we expect? Worse than we expect? We don't know. That's the art of investing. So that's why we do a low, middle, and high. And you can change this to only do one if you want. But low, middle, and high allows you to put ranges in there. And the ranges can be very, very massive. But that's okay. We did Sleep Number recently with our friend Gary.
Yeah.
He had a range of value on Sleep Number between like $15 and $120 a share.
Yeah.
And he was like, but look at the chart. Look at the pricing. It has gone that wide. Right. It's been as low as 30 cents in the last 15 years to $120 a share. So that's the whole key here. So let's start going at this one. I'm going to do 20 years here. You're all that I need. By the way, I think that song by Kelly Clarkson, her Christmas song, is better than Mariah Carey's.
I don't know what you're talking about.
Grow up, Mo. All right, Mo, what'd you put for your assumptions here?
Okay, so revenue growth, I did 5, 8, and 11.
That's exactly what I did, but for 20 years.
Really?
Mo, I don't see how they do less than 5%.
So I guess when you start pulling out, like, this is almost weird.
By the way, Mo's shocked that we had the same number because I had mine on 20 years. He had his on 10.
I'm almost thinking that the longer you go, the more revenue there might be. Because call it 10-year period, the world grows a little bit. Call it 20-year period, you're in Africa.
It compounds itself.
You're in it.
Yeah, maybe you're right.
I mean, it's possible. Listen, wherever they get computers, first website everybody's going to is google.com.
Unless you're in China.
Unless you're in China, then you go to
Baidu.
JD.com. What is it? Baidu. There you go.
Yeah.
Okay, profit margin. 21, 23, 25.
Oh my gosh. 21, 22 and a half, 24.
21, 23, 25 free cash flow. Although I could have kept this rate at 22, I think.
I did 21, 22 and a half, 24. PE.
14, 16, 18.
I did 15, 16 and a half, 18. Okay. Same with price of free cash flow.
And return.
Annual return.
12, 14, 16.
I went to 12, 13 and a half, 15.
I like it.
All right. So analyze button. Now here's the interesting part, guys. On my watch list, the stock's currently at $90 on my watch list. Look at this though.
Yeah. For
a 20-year horizon, we have a low of 70, a high of 120, and a middle of 90. So guys, according to this, if I believe that top level is going to happen, I'm a buyer all day of the stock.
Mm-hmm.
Because I got 15%. This is a higher margin of safety here. Our stock analyzer tool doesn't just factor the stock price. It factors in the cash flow along the way. But basically what that means is this is a multi-bagger to the max. 15% return a year for 20 years essentially is 16 times your money.
Wow.
16 times. That's a lot of money. Now, it doesn't come necessarily in the stock price only. They might pay dividends out along the way. All these things that might happen to add the total return to that. And I look at this going, that's why my watch list,
buying back shares,
$90.
Yeah.
I should probably start I already have puts out on Google at lower prices.
Yeah, my watch list is 92. I have puts on it. Low end $65, high end 105, middle ground $85.
And look at us. I'm 67. Great.
Yeah.
All right. Next stock. TRowe Rizzle. TRowe Price. I should have said TRowe Prizzle. TRowe Pringle. Too soon? I said TRowe Pringle. Where's Nicole?
Yeah, probably too soon.
Too soon. Okay, so.
I own his brain, by the way.
So TRowe Price, I love it because great balance sheet. They're a 401k company. People every month, no matter if the market's up or down, are shoving money into their accounts. Let's go back to 2007, 2008 stock market crash. Look at their revenue. It fell, don't get me wrong, but it rebounded very quickly.
Yeah, I remember that one.
Look at that. And their profit was still highly profitable in that time. Low debt, total liabilities of $2.3 billion, total current assets of 3.1. So total cash on hand, 3.1 billion, total liabilities for the entire company, 2.3.
Yeah.
All right, let's go to the 8 pillars.
8 pillars.
8 pillar thriller.
Everything looks great on this company. Cash flow looks great, everything.
What's their return on invested capital? 5 years, 18.4%.
Yep.
1 year, 16.5. They pay a dividend. Now the dividend eats up about 40% of their free cash flow. That's not bad, but 4% dividend yield. Okay.
Let's see here.
Let's go to analyst estimates. What are you doing, Mo?
I'm checking when they bought their shares back. Yeah, they're the same boat. They just buy them back every year.
God, I hate that.
Yep.
All right, so here's their EPS. They're going to be stagnant, according to analysts. Is that true? I mean, if the market doesn't go anywhere, I think that's accurate. But they're not looking at much EPS growth over the next 4 or 5 years. Revenue growth, again, not much here.
Yeah, I'm looking at this going, maybe that's a little skewed. I mean, if people are pricing in recession, slowdown, whatever, maybe people don't go to wealth advisors, don't keep putting money in there. And I think that's kind of that immediate thinking instead of.
But TRowe is a 401k business through their work.
I think it's going to go
I think people are going to keep adding money to their 401k.
Yeah,
now, this is why I like this one being a 10 or 20 year analysis. I'm going to do the 10. I'm going to do the 20. Mo's going to do the 10. 10 years, we believe the stock market's going to be at current levels or lower in the next 10 years. So you're going to see very little growth. Doesn't mean you won't make money as long as you dollar cost average, which these 401k people are going to do. So that's why I want to look at 20 years where I think my assumptions will be higher than Mo's. All right, so revenue growth for 20 years.
All right.
All right, Mo Hussein, what'd you do as your estimates?
My revenue growth, I did 2, 4, and 6. What'd you do?
3, 6, 9. Damn, you're fine.
You know what's funny? I did have 3, 6, 9, and I was like, I'm going back 2, 4, 6.
I think for 10 year, I think that's fine.
Yeah.
But I think for a 20 year, we could be in a new secular bull market then. People are really adding money in there.
And the reason I did tone it down is because I was like, man, if the market doesn't go higher, then maybe the growth isn't as large. So I looked at it that way. 29, 31, and 33 for profit margin.
I did 30, 32, and 34.
Okay. Same thing. I did 29, 31, 33 for free cash flow margin.
So I did 27, 29, and 31 for free cash flow.
Okay. PE 14, 16, 18.
I did 15, 16 and a half, 18.
14, 16, 18 for price to free cash flow.
Okay.
And 12, 14, 16 desired return.
Same with me. So I went higher as time went on. That 9% growth, I need that high margin of safety. I currently have it on my watch list at $100. And look at this, Mo.
Yeah, mine's at $90. Oh, you're a lot of green there.
I'm 100 to 110, high side 150 to 170. And guys, by the way, if you watch our other TRowe videos, I didn't come up with this. No. I came up with much lower numbers. Yeah. I was more conservative. I was assuming I wasn't factoring in return on invested capital as much. I gave a higher multiple. This is the part of the art of investing. As time goes on, my process will change as I learn more about how companies make money. And I think that TRowe is a leader in 401ks, and I don't think that's going away.
No, it's not going away. And
like I compare this to Charles Schwab. I didn't like Charles Schwab's balance sheet because they're more of a broker.
The only way I see this going away is if they get bought. Technically, that's not really a way.
Like I'm already doubting myself here.
My numbers are 104 on the low end to 137.40 on the high. Middle ground 120. And
our middle ground's pretty similar.
Yeah.
Our low is pretty similar. Our high is much different. All right. That's where we look at TRowe. Final company, Berkshire Hathaway. Now, we made a video on Berkshire Hathaway recently where I explained how to look at Berkshire. Now, here's the issue with Berkshire Hathaway. Because of SEC rules, they are required to report their stock, not their personal stock, the stocks they own going up and down in value as a gain or loss on the net income. I think that's absolute garbage. So I don't think you can look at that. You have to look at their cash flow and price to book value. Warren Buffett always said he'd be a buyer of their stock at less than 1.2 times book value. So the first thing I'm gonna do is I'm gonna go there. Go to the balance sheet. Book value is $455 billion. 1.2 times 455 is 500 and call it $50 billion market cap. The current market cap is 695. So I'm already looking at that saying, okay, we're probably 25% overvalued. So where does that take the company based on that? 25% of 315 is 80 roughly. So 235. That immediately off the dribble, I'm like, okay, 235 probably sounds somewhere where you should be.
Yeah.
Okay. Where's the low for the last year? 259?
The low is 259.85.
But here's the interesting part, Mo. Just 3 years ago, it was at 206, 226.
Yeah.
And after during the COVID crash, it fell to...
I see 179 here in April of 2020.
I think it was lower than that, Mo. Yeah, 162.
Wow.
March 23rd, 2020, the low of the market.
Wow.
All right, look at the 8 pillars. Not enough data because they're weird about the balance sheet. The balance sheet's strange there because they have so much insurance. It's just not the normal balance sheet. So another way to look at it is some multiple of cash flow. All right, so let's go look at their cash flow. Their 5-year average free cash flow is $24 billion. Okay, so a company with their ROIC, Mo. Oh, we don't have an ROIC.
We don't have it probably because the way that...
So I look at Warren Buffett and Charlie Munger as like, these are the kind of guys who are probably getting a higher return on invested capital.
Right. And through all of their businesses, it's very high.
So call us 25 times 20. You're at $500 billion. Okay. I think the next 5 or 10 years are going to make a lot more investments and deplete that cash is making nothing along the way. So I look at this saying, okay, it sounds like it's somewhere in the low 200s range. So guys, let's go to the watch list. It's on my watch list here at less than 250. So basically saying, Paul, start selling puts below 250, start selling the puts for like 220, 200. I basically look at Berkshire Hathaway as an ETF. They own 90 businesses. They have a lot of stock. They have a lot of cash, and they're going to reinvest at hopefully high rates of return. And I think eventually they'll be giving a dividend out. All right.
I think they're gonna have to with all that cash.
So if you like this, we have more videos on the stocks I want to own for the future. Subscribe to the channel. If you like the software, we have a great offer right now, risk-free. Use the software for a month. If you don't like it, email us, money back guarantee. Thank you for your time. There are 3 things that you absolutely need in order to be a successful investor: the proper mindset, the proper emotion, and the proper process. Which ones are the most important?